Many thanks for coming here. I know you already had 2 lectures today and the sun is nice out, so I feel honored you're all here. And also I'm very honored to be invited by the FMM conference for this graduate students lecture. I know it's always a very specific selection of highly interested young economists, mostly information, so I'm glad to present some work here, which is, you saw the title in the program, about currency hierarchy, so global financial monetary asymmetries and challenges for economic policy in emerging economies. I will take you first back. Most of you are young. And so 20 years ago, it's something you don't remember. It was not your time. So I remember you, that this was a very different time from today. Edward Rose, a really high standard US economist, coined the term in this time that inflation targeting is Bretton Woods reversed. What did he want to say with that? He said, we now have rules like, for example, inflation targeting, which central banks do follow, which is a rule not controlling the amount of money, but just the interest rate with a series of instruments. And this goes so smooth that they achieve a level of stability, which is similar to the period of the post-war Bretton Woods period. So we have stability. It's all easy, and we have all the instruments we need for that. So inflation targeting and adequate policies keep your fiscal accounts under control and don't mess around too much with prices, etc. Everything will be fine. Translated to the international level, the idea was that floating exchange rates would do the job by smoothing external shocks towards the domestic economy, and this should be the same receipt for advanced economies and for developing or peripheral economies, however you want to call this. Well, this is kind of 20 years ago, and what you know is that it didn't come like that, quite differently. We had the global financial crisis, 2008, and ongoing, which was the major financial and monetary shock in advanced economies. But before this, we already had, and this was something economists like Rose had purely ignored, a series of financial crises in emerging markets, starting in Asia, but rippling through the world over Russia, Latin America, Eastern Europe, etc., which had a similar pattern of a kind of a financial shock as the global financial crisis had for advanced economies. And by the way, economists focusing on peripheral economies call this North Atlantic financial crisis, the 2008 crisis, because it was focused on advanced economies. What we have had since then, and this you know very well, is a series of shocks, and today we are in a time of polycrisis. Shocks are happening in very short periods of time, and they are interweaving each other. So the COVID crisis and the climate crisis and the inequality crisis, etc., they all feed into each other. And what we have when we look in financial terms on the global level, rather unstable behavior of global financial flows, which reflect these global shocks and which reflect policy changes, especially of the big global central banks. And they have highly destabilizing effects on especially emerging markets and developing countries, despite the fact that most of them are now following at least formally a rule of inflation targeting and keeping domestic accounts in check, etc. We also have, since then, a huge debate on inequality, which also has reached beyond the national level of taxation, etc., and which went to issues like globalization. Globalization causing inequality, often discussed at the domestic level, but I want to bring it here to the arena of global money and finance. We have structural inequalities here which restrict the policy space of emerging markets and developing countries. a preliminary note, I will use the terms of developing countries, peripheral countries, global south, rather as the same. All of these concepts have their pros and cons. For example, global south now assumes there's a difference, a distinction between they are independent. Peripheral is a bit, some find it a bit pejorative, etc. So all of these terms have their limitations, so let me use whatever comes. Okay. Yeah. Well, yeah. Okay. Now, let us look at the world of currencies. This is a statistics which the Bank of International Settlement publishes every 3 years. So we have the only data now until 2022, which is the measuring of the turnover of all international financial contracts which have two different currencies at both of their ends. So it sums up to 200 at the end, because we have two currencies, right? And what we see here is that the use of the US in financial contracts of all kinds remains rather stable. From 90 to 88%, this is very little. The euro has had a peak since in its introduction and the first years of almost 40%, but after the euro crisis went back to 30%, which is more or less the economic weight of the euro member countries at the global level. The Japanese yen went down, the British pound was rather stable. We have the Australian, the Canadian dollar, the Swiss franc, and the Hong Kong dollar, which have some variations but are of minor use, still higher than the rest. They are all other, well, still, we have, for example, here you see number 16 and 19 countries of the region I most work on, Mexico and Brazil. They are both between 1% and 2%. They are big emerging economies, but still. We have a highly hierarchized and concentrated use of international currencies, of currencies in the international space. And we have 150 currencies and only 10 of them have any significance internationally. So currencies are not equal at the international level. We also have, you can measure the use of currencies by its monetary functions and by different types of instruments. Here, this is the composition of external debt related to its currency. The red one is the US dollar. All developing countries, in their majority, contract external debt in US dollar. And there are some other currencies, and there's a bit of the euro, and there's a bit of the yen, whatever, but it's mostly US dollar. Yes?
I think the slide may be still on the last.
Ah, okay, I changed here, sorry, thank you. Yeah, thanks. So that's the slide for the composition of external debt. Red is US dollar, green is Japanese yen, gray is euro. So strong, extreme dominance of the US dollar. So we have a highly hierarchical use of currencies in the international realm. Okay. To explain this, how we can explain this hierarchy and what this has in terms of impact for policy spaces for emerging markets, that's the issue I want to talk to you in the next 30, 40 minutes or so. And I want to leave time for discussion later. Okay. So I first will give you a literature survey where we took this concept of currency hierarchy from, then talk about the proper concept of currency, how we define it, then talk about policy limitations. Last point is how to improve the position in this currency hierarchy, and conclude. This is work not only of mine, but this is work I have done together with Luis Fernando de Paula and Daniela Prates. Two colleagues, we work together for years now, especially on this topic. Daniela Prates now is at UNCTAD in Geneva. Luis Fernando de Paula is at the Federal University of Rio de Janeiro. And we have published a series of papers, starting with the Journal of Post-Keynesian Economics in 2017. Then we have a paper in the European Journal of Economics and Economic Policies, which came out from a presentation here at FMM. So FMM has accompanied, or we have accompanied with our research, the FMM conference of the last year. Then we have published last year in the Review of International Political Economy a new paper with the same theoretical focus, but with a focus on emerging markets, which now are able to contract debt in their own currency and what this means. And then lastly, also coming from a presentation here at FMM, I think 2 or 3 years ago, we published again in the European Journal of Economics and Economic Policies something on frontier markets, so-called frontier markets, which are poorer countries, many sub-Saharan countries, and their entrance into global financial markets over the last 10, 15 years, and what this means for them. Okay, and we are doing a book now, organizing and reorganizing all these contributions to a logic structure, which will come out next year by Edward Elgar. And I hope I can raise your interest for this book after my talk. Okay. So there is literature around, like Edward Coase, who has been IMF chief economist in the times of the financial global crisis, and before arguing that whatever instability, macroeconomic, monetary, financial instability countries suffer, this is due to bad policies and bad institutions. So there is no global entanglement, there is no global interactions, there is no global asymmetries. But there's a series of literature, and you know this kind of literature, but there is a series of literature from other fields which goes into international global asymmetries, also at the monetary level. There is very prominently a literature from the field of international macroeconomics, the so-called concept of original sin by Eichengren and others. They came up with that already also 2 years ago, based on the analysis of the series of financial crises in emerging markets. And what they did was a purely North American approach, just drawing data and finding out that they could not find other variables relevant for the instability, for the recurrent instability of developing countries than path dependency. And they did also historical studies and found that from the foundation from the day of national independence, which came together with the creation of a currency, countries were faced with the problem that they could not incur into debt internationally in their own currency. And this holds for Asian African countries which have become independent in the late 20th century, but it holds also for Latin American countries independent since the beginning of the 19th century. So there is an incidence there, there's an inertia there, and this is what they call original sin. And the explanation they sought for was a size argument. If there are global financial markets which are dominated by one currency, this creates network effects. These markets are deep and liquid and diversified, so financial actors prefer to act in this currency because it's all there. So it's a kind of portfolio convenience approach, and not something different. But still, this has really made quite a lot of noise in the field of economics. There is literature from the field of international political economy, the geography of money. Jerry Cohen has been a prominent author for this, which has included, as he's an economist, but working a lot with political scientists, he has included in this perspective that there is unequal use of currencies, political dimensions. He said it's not only a size question how countries are dominant, for example, in international trade and international finance, but it also depends on their military power, on their political power, etc., at the global level, which makes a country one with a dominant currency. And he and others worked a lot on the so-called exorbitant privilege of the hegemonic currency. We know from history, and Cohen and others work on that also, that it has not been the US dollar which has been so dominant as the BIS statistics show. Before it has been the British pound, and for a certain time it had been the Dutch gulden, etc. So dominance and hegemony change over time, but in most periods of time there has been a rather clear hegemony in monetary terms. There's much focus in research on what this means for the country emitting this dominant currency, which Cohen and others call the exorbitant privilege, because they say this country can incur in debt, both in public debt and in external debt, rather easily, because others will pay the bill if the country is not able to pay or will inflate its currency. The inflation of the dominant currency will be on the costs of the creditors and not on the debtors. And some other privileges of an exorbitant of this having this hegemonic currency. Nowadays, it's certainly Cohen and others would certainly add a political dimension, using a currency as a political tool, as the US dollar currently is being used, so it has its privileges. But there's much less research on the impact for those whose currency is not dominant. If you look on the landscape of research, it's mostly, for example, current debate, is the US going down and losing its hegemony or not? It's mostly about the US and not about the others. And we have the focus on the others. We go back for this to Keynes' concept of John Maynard Keynes, who of course did not work on developing countries because not even the concept existed in the time of Keynes. But he, as an economist working on international issues, coming from Great Britain, which was on the decline of being a hegemonic currency and of losing its status, was very much aware and worked on asymmetric international monetary relations. So he developed already the idea that the international monetary system is a hierarchical one. And the Keynes plan he prominently proposed in the Bretton Woods original meeting in 1948 was to create a system which is globally coordinated between the nations, which would balance out these asymmetries. We all know this plan did not go through. The White Plan was the version which got the majority, which still created global institutions, the World Bank and the IMF, which had the task to do some balancing, but it was not the Keynes plan. So we have this hierarchical system. Whoops. Okay. Always when you do research, I spent quite some time in the literature survey. When you do research, you will notice that you will not do much new things. You will stand on the shoulders of many people having done research, and it's important to relate to these. So we relate to more research, and this is really important. There is literature from especially Latin American economists from the second half of the 20th century. The CEPAL has been the UN Commission for Economic Issues for Latin America and the Caribbean, which very prominently came out with an idea of the asymmetry of global economic relations between those countries providing for the global economy raw materials, commodities, and the other ones providing industrialized goods. And Raul Prebisch was the founder of the CEPAL and made the idea very prominent together with other UN economists, that there is a center-periphery relation which is increased and reinforced by free global trade between commodity producers and industrial good producers. José Antonio Campo, a president of CEPAL much later, and I think he also participated in a meeting here at the FMM, he updated to a certain degree this concept of the dependency and the asymmetry with the center between center and periphery, and translated it to the issue of financial flows, and said the dynamics of international financial flows are directed by center economies, and peripheral economies are cycle takers and policy takers. These are the expression he uses. Then it also took into account a vast world of so-called structuralist literature, which is based on this center-periphery analysis plus some Keynesian influence, which in the 80s brought forward empirical and economic analysis to explain the ongoing debt crisis in Latin America and other developing countries, and linked this not as the standard discussion to policy failures at the domestic level and wrong important substitution policies, whatever, but to global asymmetries. And finally, we took into account a group of so-called monetary Keynesians, which at my university produced in the 90s quite interesting literature on the relevance of the undervaluation of the exchange rate as a development strategy. And they came from an analysis of post-war Germany, but translated this to developing countries in the 80s and 90s. Okay, so broad world. What did we do with all this literature? Our concept of currency hierarchy. Here we go back to good old Keynes, the theory of money, where he defines what is a monetary economy. And he goes and looks into the composition of assets on which economic actors do decide upon. With the following criteria: I buy an asset, or I hold an asset, or sell an asset, depending on expectations. That's very important for Keynes. On the expectation of the appreciation or depreciation of its price, on its rentability, which is to expect it, on the cost to carry. To carry an apple is very costly because it goes rotten very quickly. To carry gold is heavy. To carry money, it's rather easy in paper form, so whatever. And then he includes something which is very Keynesian, which you as students of economics, most of you are studying economics, I suppose, know from the banalized ISLM model, which is the idea how and when people decide to spend or not their savings, the so-called liquidity premium. And the idea is that money has a very specific characteristics. It has no carrying costs, and in the situation of increased uncertainty relating to the future, keeping money in the pocket is an insurance for me, because I can solve all kinds of economic problems or problems I can solve by market mechanisms, having money to spend. And this liquidity premium is a non-pecuniary return. I cannot measure it by interest rate, but by the good feeling of having it or not having it. Okay, and this together is the total return of an asset. That's the idea. Translated this to the arena of different currencies. We have A as the expected exchange rate, which can vary, and we know from standard literature that the exchange rate does not change following fundamentals, but it's following, this is really interesting work from not only David and Harvey, but also from Opsfeld. It changes depending on expectations. if there is something changing in the expectation of a specific country, then the interest rate, the exchange rate will be impacted by this. Q is the interest rate of a specific country, defined by the central bank of this country. C is the degree, we define it as the degree of financial openness, because the degree of financial openness defines how easy it is and how costly it is to move from one currency to the other. And L is a structural variable, which we say, well, which assume it's rather long-term defined, coming back to concepts like original sin and others. Okay, to have an equilibrium between two currencies at the exchange market of two currencies, let's say the US dollar and the euro, or let's say the euro and the Brazilian real. We need to have an equality of the two variables on both sides. It's the same as I defined for you. And I label now, following this structuralist approach of a center-periphery asymmetry, hegemonic currency, which is the northern N currency, and at the bottom we have currencies which I denominate here as southern currencies. And what we can assume is that the liquidity premium of a southern currency is lower than one of the northern currency. This is quite easy to imagine if I would give you the option, if you want to keep some savings like corresponding to 100 euros in euro or in Brazilian real, you most probably would choose the US dollar or the euro. So this is the liquidity premium. And consequently, this is the only formula I'm using here. Consequently, this difference in the liquidity premium has to be compensated by the other variables, by the expectation on the exchange rate, by the expected interest rate, and by the transaction cost to move from a currency to another. This has to be higher in a southern currency compared to a northern currency. We have then a simple hierarchy here put in a very simple graph, where we have very few currencies, as you could see at the BIS statistics, where the US is at the top. We have a few key currencies like the dollar, the pound, the yen, Swiss franc? Yeah, franc. Then we have, of course, you saw that the Chinese renminbi increasing its position, but still much, much lower than the other currencies. And at the end, you have, well, a differentiation still between the Brazilian real and the Zambian currency or ruble or whatever. Right? No, ZAR is South Africa, thank you, and then below you have all the other currencies. And with that, no, okay. With that, we have an ordering of the liquidity premium. What does that mean? What's the impact? And here I take you to a small tour on balance sheet analysis. Not quantitative, but synthetic balance sheet analysis to understand how money works in the economy in an international comparison. We have the relevant actors. I first will do the very simple thing, as economists do. We start with the very simple world. We have wealth owners, rich people. We have a central bank. We have a universal bank, a bank. We have a commercial bank. We have a firm. We have a household. How do they relate? In a simple world which you do not know any longer, which may have existed well, not even, well, in some, maybe it existed in the Bretton Woods period, and I will complexify it later, where the dynamic of a monetary economy, and this is very Keynesian fundamentally, comes from the fact that the wealth owner, here is willing to keep some of his wealth in money, as a deposit at a bank. Based on this, a bank will give some credit to a firm, and based on that, a firm will be able to pay wages to households, to wage earners. And this is only possible as a dynamic process where the bank gives out more credit than it has deposits on its right side of the balance sheet, if there is a specific interaction with the central bank. Only if this wealth owner is willing to deposit money and this bank is willing to lend to a firm where it thinks, yes, there's an investment project which is rentable, which will pay out profits and interest rate, and this can be higher, this credit volume, than deposits, if there is the central bank ensuring this process behind. If the central bank, based on some reserves the bank has to deposit in the central bank, is willing to lend without limitations, but for an interest rate, to a bank in case of this credit running well to the firm, but this depositor here thinking that, well, I withdraw my money or whatever. So the bank can get uncovered here intertemporally and have short-term deposits and smaller deposits than lending out credit if it's insured by the central bank. And if the central bank has to trust the bank that it lends out to a firm which is solvent. This is the basic criteria for a monetary economy to work. And there has to be confidence between all these actors, also regarding the currency. What happens if we go to a southern economy? We have seen the liquidity premium, or I have defined, I showed you, liquidity premium lower, and ceteris paribus, among other variables, the interest rate has to be higher. So for a firm in this country, for a firm or a bank in this country, it's more expensive to lend in domestic currency here in the red lines than to borrow from abroad in the northern currency. And there can be a bank, for example, from a northern currency, from the US, which lends both to a bank in the south or to a firm in the south, because it can incur higher interest rates than to national firms, for example, but for these it's still less expensive than incurring debt in domestic currency. The problem is that this here does not work the same. The central bank, when a bank incurs in credit to a firm and gets short here because the deposit level is decreasing for whatever reason and the firm is doing well but paying its credit back next year, it can go to the central bank and lend there at the discount window without limit in national currency, but not in international currency. Here, the central bank of the South only has a limited amount of foreign exchange. And this is exactly the vulnerability a country with a southern currency in debt in external currency is facing. That the central bank is not able to stabilize the domestic financial sector or only to a very limited amount. Well, I told you this was the world maybe in Bretton Woods. Maybe even in Bretton Woods it was not so easy. Since then, the world has changed dramatically. And this is the world you know. We have something Chesnais has labeled as financial globalization, where we have much more agents. Nowadays, we don't have only banks and wealth owners. We have investors. We have states engaging in financial transactions, etc. We have financial contracts nowadays in all currencies, cross-border. So we have a certain increase, you could see, of currencies which are not the US dollar at the international level. Even a currency like the Brazilian real or the Mexican peso are traded internationally. And we see here that the magnitude and the composition of cross-border flows involving developing emerging markets and developing countries has increased. It's much more diverse. We have portfolio equity, debt liabilities, etc., much more than bank credit and transable transactions. So something which is very liquid can be sold and bought, and the volume has increased dramatically. With this, our balance sheet analysis gets much more complex. This is the issue we're treating in depth in the paper in the Review of International Political Economy, RIPE, Political Economy, on the metamorphosis, what is happening with countries which are able to shift and to borrow abroad also in their own currencies. This is the case for emerging markets like India, like South Africa, like Brazil and Mexico. And the idea in principle would be, oh, great. They have a reverted original sin. If they devalue what I forgot here to say, sorry. So what is the vulnerability is here, the central bank cannot cover and stabilize the financial sector. And also, what happens if the international interest rate changes? If the central bank here, let's say of the north of the US, is raising interest rates, then it becomes much less attractive to offer credit to southern economies, so southern agents, because the interest rate differential between the north and the south decreases. What happens then, and this makes this pro-cyclicality of global financial flows, is that they withdraw credit here in the case of an interest rate change. This makes here this financial sector uncovered, maybe also the firm, in terms of their balance sheets, because they have a reduction of their assets, of their assets, and the liabilities are the same still. And this will have an effect not only on the sector, but also on the exchange rate, on the very diverse manners. There are many channels for the impact in the exchange rate. What we'll have here most probably is an exchange rate devaluation. What happens then in the case of a exchange rate devaluation? For this firm, for example, which let's take an Argentinian firm producing freezers, has taken $1 million US debt for an exchange rate which was $1 to 1 Argentinian peso. Due to the interest rate change and the instability here, the exchange rate of the Argentinian peso has to be adjusted to $1 to 2 pesos. This means that this firm, as long as it is also operating a national currency, has to pay double. It has to pay 2 million pesos for the same nominal debt in US dollar. This is the balance sheet effect which occurs then in the case of exchange rate changes for these debtors. And this is what triples instability. This is instability which trickles through the system. If those are unstable, then households get unstable, lose jobs, then the state gets unstable, then there's even more pressure on the exchange rate, etc., etc. Okay. The good thing here is that if there is an increase of the US interest rate, for countries like Brazil, which has incurred into debt in its own currency internationally, because there are international investors willing to hold credit in the US dollar, when the Brazilian real devalues, this is a negative balance effect for the creditor, let's say for the US investor. which sounds great. So it seems in the first moment this is original sin reversed. It shifts the costs of adaptation of the key price of the exchange rate to the creditor, to the international creditor. But what authors from the BIS started to elaborate, and what we do in this paper in much detail, is that this has feedback effects. For example, if these US international investors hold assets on the Brazilian stock market and suffer this devaluation, they will probably sell part of the stock. And this will have an impact on the stock prices in Brazil. So it will have an impact also on all other stock asset holders in Brazil. This will have an additional effect on the exchange rate. There will be further devaluation. So there are second round effects which then re-push in a very complex manner the costs of instability, of shifting of global monetary policy again back to southern economies. That's the idea of the original sin redux. That's how the BIS authors call it, and where we go into detail in this paper, in this most recent paper, on who probably might pay the cost for this in these emerging markets, which is most probably the financial, the private sector, with costs, with effects then on the public sector, etc. Okay. Time to come to the limits for economic policies at the bottom. What are the implications of all that? First, let's go. I only go through monetary and exchange rate policy as exemplary areas to have time for discussion. For the monetary policy space of countries with a southern currency, it means that they have to maintain an interest rate, a nominal interest rate, which is higher, and a real interest rate, which is higher than the interest rate of the hegemonic currency. And when you look at the interest rate profile globally, you will see that all emerging markets, except some rather unstable exceptions, have in monetary and real terms higher interest rates, and in some cases much higher interest rates than the US Federal Reserve. Because they have to compensate. People have to have an incentive to maintain anything in that currency, so they want to have higher returns and pecuniary returns, higher interest rate payment. This means that incurring in debt for investment has much higher costs. Again, I take the example, let's leave out Argentina, which is a very unstable country and a very exceptional one. Let's go to Brazil. Chronically, the interest rates are much higher than the US dollar. And if you go to the financial market, private banks, you would like to have a liquidity credit for your firm for 1 year, you pay 20% of interest rate or 30 or 40%. If you're a consumer, you pay 50 or 80%. And this is enormous cost. This means that everybody tries not to go into debt. And this means that investment is much lower, or at least not into debt in national currency. So firms do save, firms do invest financially, whatever, but the investment rates in many southern economies are much lower due to this higher cost and due to the instability linked to external debt. This means also for monetary policy that the body were to act on with monetary policy is much smaller. The central bank has not only the aim in most countries to stabilize inflation, but also to moderate or to influence growth. So it goes on both sides. So an increase or a reduction of the interest rate has much less effect on the real economy. So the interest rate hikes, especially going above, have to be much higher than in an economy like the US or the Eurozone. This means that adjustments in the case of drying out external capital inflows, international capital inflows, has to be a very sharp one with high interest rate spikes, which have a huge impact on the real economy. So growth rates remain lower and more unstable and volatile in these economies. So, and you see here, this is a graph which is wonderful because it goes back until 1945. Here, for a group of countries, these economists found that for, you see here the orange line, which is advanced economies, and the green line is a small group of developing countries where they found data for this long period. You see that for the period of Bretton Woods, when the financial internationalization was rather low, they could allow themselves to have interest rates many times lower than those of advanced economies. But with financial globalization, the pressure has increased very much. So most of the time, interest rates in developing and emerging countries are much higher than in advanced economies. For the financial depth, this is also an old graph, but it hasn't changed too much, especially regarding the volume of credit in relation to GDP, which was one standard measure of financial development. And you see here, especially in this comparison, that for emerging markets and developing countries, in their average, it's much lower, this blue bar, than for advanced economies. So the banking sector is much smaller. Many of you know about the financialization discussion, which talks about too much finance and too much banking or whatever, but you also can have the reverse side, far too little. Far too little money being organized by the financial sector, by the banking sector to fund investing. Okay, second policy field, the exchange rate policy. These countries, due to this monetary asymmetry, are exposed to boom-bust cycles, which are mostly defined by monetary policy, by the key currency emitting central banks, and mostly today by the US central bank, Federal Reserve monetary policy. And what we have is, and we can observe this repeatedly, these booms, that in periods of low US dollar interest rates, it becomes very attractive to invest in the Global South because interest rates then they are much, much higher. You can't get big earnings in the North, then you go to the South. And this appreciates the currencies of these countries. If nothing else happens, because there's much more inflow into that currency and more demand for the currency at the global level. And this builds up certain, exposes both banks and the financial sector and the non-financial sector to risks which are linked to potential future, economic fluctuations, but also especially monetary and exchange rate fluctuations. In the bust, what we see, and the COVID period was really telling here, for a very short period of time, it's the first assets global investors then sell. If there's something is going wrong, they withdraw from more riskier places. And the more riskier places are those with southern currencies. So in the beginning of the COVID period, we had a sudden outflow of more than $50 billion within 3 weeks at the global level from all emerging markets and frontier markets as a reaction of this shock, of this COVID shock, and of increased uncertainty. Of course, with enormous effects on these countries. Part of this has been recovered, but we see since the 2010, since this period of great moderation has passed and has ended definitively, we see all the time huge cycles of capital flows, which are in part linked, of course, always to specific conditions of specific countries. If there's a specific crisis in a country, this affects the capital flows, but we also have global shocks which ripple through north-south investment. What can central banks then do in policymakers? They can do very little. There's a global shock, there's an interest rate increase in the US. What they can do is to raise the interest rate. And as I explained, the raising of the interest rate first in this moment has nothing to do with national inflation, with national employment, with whatever. And second, it has to be a high spike to really give a strong signaling over a very small financial market. Another possibility is to to deepen financial openness, to reduce the cost of transactions. Something countries did, especially in the 90s and the 2000s, and many of the emerging markets and developing countries today are at the level of a rather high financial openness, because if you need to maintain capital inflows, you do what you can to maintain these inflows and make life for international investors easier and take down part of capital controls, taxation issues, or even only administrative issues, how to move between currencies. And when this all is not successful, countries enter in currency crisis. And currency crisis then can translate very rapidly into financial crisis because of the balance sheet vulnerability of the financial sector, related to exchange rate variations. It then can very quickly enter into a public debt crisis and in an international debt crisis. We very often have financial crises in countries with such currencies which come with all characteristics altogether. So they have multiple crises which are a big financial crisis of that with many variations at the national level. And we have, at the end, a much higher volatility of exchange rates of southern currencies. This is something standard economists have worked a lot on, showing the higher volatility. Later, there has been work first by Flassbeck, who also has been a frequent, half-frequent participant at FFM conferences, and Helen Ray later, which did present at the Bretton Woods conference, so pretty much in standard economics, showing that the idea that flexible exchange rates can protect countries from these fluctuations is wrong, as long as they have an open capital account. They're exposed to these fluctuations. Okay, so we have with that, only with these two fields, so this has an impact on fiscal policies, on the ability to pursue industrial policy, social policy, redistributive policy, whatever. We have a policy space which decreases, correlated with the liquidity premium, or negatively correlated with the liquidity premium of a currency. How to tackle this? How to go around with this? Key, from the theoretical perspective, would be to reduce the volatility of the exchange rate, both in the short run, because it implies in so many negative effects of economic volatility, of overall monetary, financial, and economic volatility at the short term, to protect a country against the high costs of this volatility, and second, to try to improve at the longer term the liquidity premium of a country. This is nothing which can be changed. The perception on a currency cannot be changed from one year to the other. This is something which seems to be a rather long-term issue, but both involves the short-term management of this kind of vulnerability, and both the intention to climb up the ladder of this hierarchy involves basically the management of the exchange rate, because a more stable exchange rate protects the monetary policy from being so pro-cyclical and so reactive to international capital flows. The idea from part of this literature I cited, these monetary Keynesians and the structuralists in Latin America, is to achieve even an undervalued currency as a long-term strategy, to achieve a current account surplus, to protect the country, to enable a country not to run external debt, to be not exposed to the negative effects, or much less exposed to the negative effects of capital outflows in the context of global shocks. If a country has no or very low external debt, then the negative effects of the exchange rate valuation on the domestic sector are much lower. And all needed for the capital good, technological imports, etc., can be realized based on foreign exchange earnings by exports. For this, there has been a more recent debate, especially in the aftermath or in the context of the global financial crisis, that capital account regulation, or in a more older-fashioned term, capital controls, have a high relevance. There has been a long discussion. The IMF has been finally shifting its position of a total institution totally against all kind of intervention in the foreign exchange market towards a position of, well, if the country can really do nothing and is running very well and we have huge capital inflows, the country wants to stop it, then it can do it, but only as an exceptional rule. And there has been other literature coming up and saying that a country needs to have these kind of controls in place to protect itself also at the longer term and over time, and not only in exceptional periods, against the vulnerability brought by the instability of these capital flows. Another issue is financial development. Banks being able and willing to lend at longer term and at competitive rates also for the productive sector do not come out from nothing. That's the experience also from advanced economies. There is needed a lot of institution building, like public banks, the governance of the financial sector, etc. Inflation targeting, when you look on the relevance of exchange rate management, becomes a very poisoned instrument, because inflation targeting, the pure inflation targeting, is a rule which assumes that you let the exchange rate fluctuate in order to stabilize the price level. The price level is the absolute priority, but you cannot maintain this priority of price level and then the exchange rate will support that. This has led to an overvaluation, to an appreciation of many emerging market currencies, and one of the analysis I find quite interesting of a series of emerging market financial crises, for example in the 90s, is the application of inflation targeting in these countries. There is a high need for policy coordination, for very refined policy coordination to support a stable and maybe even undervaluated exchange rate, which gives more leeway to a monetary policy which is less pro-cyclical, where fiscal policy should be over the cycle rather stabilized. So the idea of modern monetary theory is rejected by this kind of, for countries with southern currencies in normal circumstances, is rejected or rejected. And it also limits the space for wage increases and for redistributive policies. We have worked in other papers on redistributive issues, which are key for most economies in the Global South. But the balancing with the macro side is quite delicate. Okay, to conclude, what we want to say here is that this currency hierarchy is a structural feature of the global system. It's nothing from today or from yesterday, but since the creation of the capitalist global economy, we are confronted with this structural hierarchy, and this imposes limits on countries which are on the southern side of the global economy. So it allows us methodologically to go beyond the analysis of the situation of country as a national container. We can combine the analysis of national policies with international features. This is methodologically quite important. We can, based on this, argue that currency hierarchy, as abstract as it is, it has a huge impact on global inequality. It's not only trade and whatever, it's also monetary and financial relations which create inequality. To climb this ladder, it's very challenging. I told about the delicate balance of different policy arenas. And it depends. A country which, for example, is incurring very high debt levels, at this moment it find much more difficult to establish its exchange rate. So this is much easier for a country with a very low level of debt and a low level of vulnerability. So there is a certain inertia, which is not so easy to overcome. It depends on a set of institutions and policy sets. It's not an easy receipt box you hand out to countries and they can do it. And it's nothing for short-term changes. And it's not a strategy for everybody, because incurring on an undervalued currency and running export surpluses requires other countries to having an appreciated currency and to accept import surpluses. The world is a closed system. We do not export, at least not now, not yet, to the moon or whatever, so the bills have to close. So not all countries can climb up, and the structural hierarchy will remain, but the positions can change. And I would like to invite you to use this as a framework for research, or all kind of research, to go further in theory building as we did, to do a historical analysis on countries, to do policy analysis, country studies, whatever. Thank you very much. And now we have plenty of time for questions and debate. And yes, you should speak. You know that already. You should use the micro because the session is being recorded.
Hi.
Hi.
Thank you. So I'm Guilherme from the University of Pisa. Thank you for the very interesting exposition. So I think you were very clear on the macroeconomic and financial stability sides of the story. I wonder if you could explore a bit more the implications in terms of income distribution across countries of this type of hierarchy. So I have a couple of questions on this. One of them, of course, maybe the most obvious, is that advanced economies, the ones that are in the top of the hierarchy, they are able to finance whatever trade deficits they have. So this also could imply they are extracting real resources from the rest of the world because they are importing more than exporting, for instance. Another comment that I found in David Graeber's book, a very provocative comment of him, is that when countries are kind of always buying American bonds and they have negative real interest rates, he compares this with the old times when the empires were extracting taxes on colonies. So basically countries are financing at a negative real interest rate the advanced economy, so I would like to know what you think about it. And finally, when it comes also to the green transition and ecological implications, there's also a growing literature on the unequal exchange of resources. And I think that the currency hierarchy also plays a role, that's because it traps peripheral economies into keep exporting commodities and resource-intensive goods for the advanced economies? Those are my questions.
Okay, thank you. I would suggest for the next round we collect, but as there are 3 questions, I go for these. And try to be rather quick to give time for further questions. Okay, these all are following ups of this, which I agree. First, the ability to finance trade deficits. This is especially true, of course, for the hegemon, but also to some degree for key currency holders, but only to a certain degree, because there is limits always, where trade deficits first, they cause job losses. We know that trade locates jobs in different places and profits, and also financial rents. But it's true that for countries with a southern currency, it's much more difficult to maintain trade deficits because it opens their current accounts up for vulnerability due to capital flow reversals. If you have a capital account surplus and capital flows out, okay, might be a problem. But if you run a deficit and then capital flows out, then you quickly run into a debt crisis, into a liquidity and a solvency crisis. So yes, correct. The privilege of emitting bonds and whatever instruments with the negative interest rates the US is in part using. This is always specific periods. It's not a constant thing. This is what Cohen and others call the exorbitant privilege. You may compare it with colonization, but it can happen absolutely without any colonization. The same happens if euro investors from the euro area do invest in these bonds. They have never been colonized by the US, but it's still a transfer of resources. So colonization is sometimes a good concept to address asymmetries, but sometimes it goes beyond the historical phenomena of colonization. The link between between the currency hierarchy and the unequal exchange of resources. I think this is a very important link, and I would argue it. There is literature arguing it from the national resources side. I would argue it from the policy space side. Countries which have such a currency with a low liquidity premium, they have very little space to run monetary policy, which is pro-growth, and run fiscal policies, which are pro-growth, and run industrial policies. Things do not happen. The structural change usually does not happen by market forces. What free trade is doing is reinforcing existing structures and asymmetries. So if you don't have not only institutional strong states, but also financially strong states, which are able to influence, to intervene in the economic structure of an economy, which historically has been linked to the extraction and exportation of commodities, it's very much more difficult to diversify the economy. And when you then run into liquidity problems, you have to export what you have. And then you go back to the old, good or bad stuff of commodity export. So there is a strong link, yes. And I would translate it, together with the structuralist economists, into an inability to pursue productive diversification. Okay.
Do you want to choose who will talk? Would you like to choose who's
I didn't see who was first. Did you see? Okay, let the lady first go and then you, right?
Hi, thanks for the lecture. I enjoyed a lot. I am thinking about the political implication, the policy space. I am from Argentina, so I know the difficulty of this. But I agree with the description and the policy that you state at the national level and are very difficult and are not promising this. I was thinking if you or any of your colleagues think about like supranational alternative levels. I mean, I am not talking about, I don't know, a new international monetary system like Keynes, but maybe more reduced. But for example, I am thinking in the BRICS and the idea of the development bank and lending in the currency of, I mean, any of that kind of supranational alternatives, like to complement the other, like the national level policies. And what do you think about it?
Okay.
Thanks.
Yeah. Then we had here, I would now collect it here, a question. Oh, and there are more. Okay, so we have to speed up. Yeah, right. Yeah.
I'm Johnny Dorsey. These are just few comments to your beautiful and convincing presentation. I mean, one is you showed clearly the fundamental incompatibility between financial globalization and development, I mean, at the end of the day. And one could use the opposite to say, look, the only really successful case is China that has operated the delinking between participation to trade flows and financial globalization. And she has cut the two levels, participating in one in a very successful way and being out of the other. This, I think, it has already been said, emphasizing the importance of, I don't know if they are successful or not, but the BRICS attempt to have alternative financial instruments. The final comment is, I was thinking, also in relation to the presentation that I'm going to have tomorrow, the fact that the financial globalization induces an enormous increase in the rents, the rent formation within the countries and across countries, because when you have real interest rate of 20% in Brazil, clearly the rentier become the dominant the dominant receiver of the share of income. And at the same time, you have transfer of rents from Brazil to, say, the US. So, in fact, it's a fundamental part of the general rentification of the economy that has got other sources, but this financial globalization is a fundamental one.
Okay, thank you. Then I saw you here, and then I have a series of hands raised here.
Which one?
Here. I'm not sure if I got the right order, but everybody will have time.
So my two questions are, why does a country need to incur external debt in the first place? Couldn't they just run an expensive fiscal policy if they control their own currency? And the second question is, you touched on it briefly, but you didn't expand on it. What would Keynes have suggested that in his proposal that would have combated this problem of currency hierarchy in the global economy?
Okay, thank you. So I make a cut here, give short rounds of answers, and then we continue. Okay, thanks for the questions. 2 times the BRICS question. Of course, we have, since yesterday, the BRICS meeting, and one of the very much public noise-producing proposals is to incur into an alternative financial system using the currency of the BRICS countries. From this research agenda, I have shifted to another research agenda, and this links also not only to BRICS, but other mechanisms, to what kind of alternatives do countries have not to incur into external debt. If we would take seriously the empirical conclusion of Eichen-Green et al., or if we do take this seriously, they argue that the bigger a currency space, the more is the currency used. So would it help, would it make a difference to increase the currency space by joining countries, by monetary cooperation and monetary integration. This is a research area I've been following also now for 10, 15 years. I'm running, for example, a tracker, an online tracker on the so-called Global Financial Safety Net, which provides short-term liquidity by regional arrangements in Latin America, in Asia, not so much in Africa, but in different places in Asia. So is there an alternative from Bretton Woods institutions and currency-wise? It's not so easy. We all know that, but there is much more. It's much more easy to talk politically about this than to do it. And there are standard arguments which are to be taken seriously, but they are not all. The standard arguments are that you need a very refined system, which is complex, which involves specific banking institutions, pipelines, mechanisms to make a currency internationally tradable. We know, for example, for the renminbi internationalization, which is a policy of China also, what kind of complex institution building this has been involving. You need corresponding banks in another country which is able to deal in 2 or 3 currencies, to accept in another currency renminbis and to be able to sell this. This is a very specific institution. You need something like the SWIFT, which is an alternative, which is only an information system. You need mechanisms to transfer between countries. This is all very costly, and it has very high sunk costs, and of course size and depth and liquidity of markets here is very decisive. So if you want to do a transaction today in renminbi, specific countries can do this, for example, if they have trade with China. Then you get credit in renminbi and you pay your imports from China directly to China. But if you import from the euro area, you cannot use your renminbi. So that's why the dollar is so convenient to use. That's one issue which is not so easy to tackle. And the second reason is that and that's a standard argument. So, but if you look at, and we did that into detail, for example, Argentina is involved here at the Sistema Monetario y Moneda Local, a regional payment system which allows member countries of the Mercosur, Argentina, Brazil, Uruguay, Paraguay, to do regional trade in their own currencies instead of exporting from Brazil to Argentina and having to go from Brazilian real over the dollar to the Argentine peso. A very nice small system, very smoothly run by the central banks, very carefully constructed. This is all but easy, and it's the only regional payment system we found which really works, but at a very small scale, because it's mostly used by Brazilian exporters, because Argentinian exporters, for example, they don't want to have the Argentinian peso as their income. They want dollars, so they don't use the mechanism. So it's very tricky, this kind of institution building. And then going to the BRICS, we have now the militarization of currency issues, the militarization of the US dollar as an instrument of international political relations, which has a huge impact. So anybody dealing with mechanisms where the Russian ruble is involved runs the risk of being banned from certain mechanisms like the SWIFT. And this has extremely high costs. In China, for example, for international renminbi operations, and these started with countries which are banned from the US dollar for a longer term, like Iran and other oil exporters, and Venezuela, and China wanted to import from these countries, they set up specific banks which have not to do with the global dollar system, but they run parallelly. So they have no problem with being sanctioned by the US. But they need specific banks for that. So there are a whole set of complex issues which complicate this Still, there are lots of initiatives. I will present, or my co-author Bianca also will present a paper here at the conference. There are lots of initiatives because so many countries find it so inconvenient and find it so limiting to be dependent on the US dollar that we see lots of small mechanisms raising and a lot of experimentation around. So I would not say we will have the same world in 10 years. But for now, we see most of the initiatives, except some linked to the Chinese renminbi, rather limited. This was a long answer, but it was asked twice. And it's a key issue which is related to this. Okay, the rentier economics. Looking at Brazil, there is a double rentier economics. You have relevant regressive redistribution by those investing in public bonds and earning these 20% interest rate at the domestic level, and you have it at the global level. But you can explain part of also domestic inequality by these financial mechanisms. And this is very important to see the two levels and how they are intertwined. Why should countries incur in external debt? Because it's so expensive to do it in own currency, and because there are no banks which lend for 20 years, when they are not public banks, or 10 years or 5 years. It's a matter of limitations countries do encounter.
Unless they are public banks, like banks.
Yes. Except there are strong public banks domestically, but they are also limited in fiscal terms or in quasi-fiscal terms, because the subsidy for the interest rates has to come from somewhere. This is also a kind of redistribution, maybe more progressive, because in the best case it funds investment which creates jobs, etc. But it's also it incurs in public spending, and we have the limitation of fiscal space limited, linked to the limitation of the overall economic policy space. The Keynes proposal, that was the last question. The idea of Keynes was to have a global mechanism balancing debtors and creditors, so incurring costs to surplus economies. Countries who run large export surpluses should be taxed at the global level, and this tax should be transferred to net importers to prevent that these imbalances do grow and do create global instabilities. This, of course, incurs the willingness of the export surplus countries to be taxed, which was not found as a political majority in the Bretton Woods system. Okay, so let's continue. Yeah, I would say we go for the geographical order, here, 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 and more questions here. Oh, no, you were first, you were early, right? Okay, no, okay. Right, whatever. Okay. Yeah.
Yeah, thank you for your presentation. It was very interesting. I have two brief questions. The first one is, I was wondering why you started that entire monetary circuit story with a wealthy individual holding his deposits in a bank account. To me, that sounds a bit un-Keynesian, to be honest, because, yeah, to my understanding, like, saving comes from investment and not the other way around. So I was wondering why you did it that way. And that leads me to another question, because if we assume that, for example, banks can just extend loans without any money being there as deposits, then there's, in my opinion, no need for international investors and no need to raise interest rates to a level that attracts them. Yeah, so why is that so important, and why can't just interest rates be lowered as a policy variable? And the other quick question is, what is your opinion on swap lines from global north central banks to global south central banks? Wouldn't that eradicate this liquidity difference and make the entire system more like symmetrical? Thank you.
Well, hi, thank you for the talk. It was very interesting too. And I was wondering, because we've talked like about the hierarchy of currencies all around the world, and I was wondering if you could maybe go deep inside of the same currency areas, because the same currency areas as the Eurozone, for example, because we've talked about a global hierarchy between currencies, but sometimes I feel that even inside currency areas as the Eurozone, for example, there are like existing hierarchies of countries, and they are not like able to access to the capital markets in the same way. For example, in Europe, I would say Spain or Greece in 2008 crisis, there were like huge disadvantages in the local markets, and when they were mostly like Northern European capital was retired, they were in a weakened position, I will say. So I would like to ask you to develop about it. Thank you.
Here was a question. Oh, it's closer here, whatever.
Thank you. I come from Mexico. So I'm really curious about if monetary authorities want to achieve another policy, for example, growth or industrialization or another objective. I think that we as global South countries, we face a challenge, a dilemma, no? Because if we want to achieve those objectives, we will face an instability, no? Because, for example, in Mexico, what is happening is that in recent years, what is driven the instability in our currency is not what is happening inside of the country, but what is happening outside. So yeah, what are our options if we want to achieve another objective? Thank you.
Okay. Here is one question, and was there one more? I can't see another hand.
Thank you. Luis Cortés, I was a student in Prague University. Yeah, I was wondering, during your explanation, I feel kind of like the elephant in the room in some way was like this global South, non-hegemonic country, which is China. Because it kind of caught my attention. It's like it became an industrial powerhouse, but then the currency didn't even appear in the first places of the first chart you showed. So, like, how was that possible? Like, and there I kind of like asked this also to try to understand better the concept of like liquidity premium. Like, it became like clearly a global potency in economic terms, but it could do so using the US dollar, right? Okay. So in the end, like, are they accepting this? Were they unable to impose, like, institutionally something? Like, what happened there? Yeah.
Okay, thanks a lot. If there's still another question coming up, we still maybe have time. Okay, thanks a lot for the great questions. I do for the order, in order not to forget. Why I did start with the wealthy person. Of course, this is a counterintuitional for the basic idea Keynesian economists want to hammer in the heads of students. It's first investment, then saving, and not saving and then investment. But it always depends how you present what you want to explain. And what I want to do with this explanation is that for a currency to be accepted, it depends on the complex interaction between different actors, between people which have some wealth, between banks and the central bank. And this is at the centerpiece of a liquidity premium also. So, of course, it may be, I can completely agree that the wealth comes from past investment. I would not agree with or I don't find the idea so useful to think that banks can create credit without any deposits. If you look at the history of banking, and our ideas have to be empirically founded somehow, deposits always have been a part of banking in most cases. But in most cases, there is a certain link. Not the same level of deposits as credit, but there is an interaction. If nobody trusts a bank to put some money in, it's difficult for this bank if it's a private institution. I'm talking here by commercial banks. I'm not talking about development banks, etc. So the specific institution. Then it will be difficult. It's not so easy to lend out and to have really a credit portfolio which is trustful. So there is an interaction. It's an interdependence. It's not a causal relationship, but an interdependence, what I wanted to show. And this is, okay, yeah, we could go further, but this is a specific topic, and if we want, we can discuss it further bilaterally. The swap line question. First, swap lines are very specific things. Central bank currency swap lines. This is a very specific instrument where two central banks bilaterally agree that they put some money of their own currency in the window for a certain amount of time and a certain amount of money for certain conditions, interest rate, and the other central bank can give a call and say, send it over to me, I need it now. And usually it's in a symmetric relationship that one central bank, it's much more probable that it will need to do that call and get that liquidity in the other currency than the other way around. So it's a hierarchical relationship which is ordered by the currency hierarchy also. And it's not just lending, it's short-term lending. It substitutes, or it's a similar functional thing like IMF short-term lending, or the Eurozone stabilization mechanism lending. It's not all kind of credit. So it's a very specific short-term mechanism to maintain a currency liquid in international terms and to prevent, in the best case, the need to raise the interest rate to prevent an exchange rate depreciation. In this global financial safety net tracker, which you can access, we are tracking also global swap agreements between central banks, which is a very difficult thing to track because it depends on the wish and willing of specific central banks to offer it to other countries, and there's no need to report to anybody. It's lots of transparency, at least in part. But we did our best to get all the data together. I think we are pretty good at that. Okay, what we see is that the US is offering, in a progressive manner, has been offering first limited in volume and time, and now is limiting unlimited permanent swaps to whom? The Gang of Five. The European Central Bank, the Swiss Central Bank, the Bank of England, Japan, and I always forget one. So it's 5 highly privileged key currency central banks which receive unlimited US swaps in US dollar over time and in terms of volume. And then the US is still offering swaps to 3 or 4 emerging market countries, depending on the count. It's Mexico, it's Brazil, it's South Korea, and I think it's Hong Kong. Always limited in terms of time and in terms of volume, much, much, much smaller. So we don't have much north-south currency swaps because of the liquidity asymmetries between these banks, the central banks, and because of the risk to offer this kind of unlimited support to a currency which is much more subject to instability. Why should a central bank do that? And we have lots of geopolitics for many smaller swaps between countries where many players are around, not only China. So what we find is that these swap arrangements, in the patterns we find them now, they further exacerbate inequalities because the better offs get the best swaps and everybody only picks and chooses whatever they want we compared China and US in their provision of liquidity swaps. There was recent literature arguing that China is offering swaps to countries which are with higher and higher debt, and so China is saving its own lending to these countries while other creditors get a position worse in that. But we find that both the US and China, their central banks, are highly selective in their provision of swaps, following their own interests. This is a renationalization of the international financial order. We can argue tons against the IMF, and the IMF also is producing inequalities, but at least it's a global institution open for all, and swaps are depending on national will and nothing else. Nobody is responsible to respond to nobody at the global level if you offer swaps or not. So it's not an instrument which reduces inequality. At least China is offering swaps to countries with lower income levels, while the US is addressing only the better offs. But it's also selecting countries where they have more trade, more financial links, etc. So everybody is doing its own game and not really providing global stability. The Eurozone. In theory, it could be a good thing. Euro is much bigger, so it gets rid of certain pressures from the US. We still see that it's below the US dollar, so a change in the interest policy of the US Federal Reserve has an impact on the policy of the ECB. It's not independent. Even the ECB is not independent in their interest rate decision from the US. So there is still a hierarchy. And of course, a monetary union is not free of any internal hierarchies. And the internal hierarchies in terms of trade asymmetries and of asymmetries in terms of access to financial markets is very marked and very there. And the euro crisis of the 2010 years is clearly linked to these internal asymmetries. Why do we still have these asymmetries, or do we have these asymmetries? Because there's a monetary cooperation, but no fiscal cooperation, and especially no wage policy cooperation. So the world is not so easy. You join one currency and then everything gets smooth and equal. Mexico. Yes, this is a dilemma. And what we wanted to point out here with this systematic theoretical analysis is that there are limitations. But at the same time, if you look at the diversity of emerging markets, developing countries, global south, there are differences. You can manage in different ways. So it is this is a field for research. We have some PhD students have doing case studies, for example, for an intermediate policy space concept, etc. So the world is not flat, despite currency hierarchies. This is one structural feature, but below the structural feature, there's lots of variation, also in how to manage, for example, the exchange rate, etc. And Mexico is a country which is highly integrated, not only trade-wise, but also financially with the US. Its financial sector is basically dominated by US banks, so the degree of independence from US policy is marginal, of course. So structural features here of specific countries do matter. China, the white elephant. What your name is? Giovanni. What Giovanni explained for China, I completely agree. China managed to integrate trade-wise, or to at least do very much engage in global trade and in exports, but not financially. China can be used as an example for many theories, and it's a very complex economy. So it's not so easy to give one simple explanation, especially for this country. And one explanation does not hold for all the periods of time. It's a changing economy, of course, also. But what China is characterized by is that it never incurred, since its growth period, since the 80s, never incurred in any significant external debt. That's exactly the case of a country which very carefully managed the exchange rate, did not open financially, or in a very controlled manner, and managed the current account very much by trade relations, by export surpluses, which allowed then to import technology, and then added by industrial policy like national ownership clauses, whatever. So China could be used in this sense without trying to be a China expert, but could be used as an example of really climbing up the ladder and not incurring this kind of vulnerability. The climbing up of the ladder does not mean automatically of the shielding against this kind of vulnerabilities which are linked with the incurring external debt. That does not automatically mean that your currency is used in international in the international context. These are two different levels, and I tried to explain a bit how complex it is being for China to internationalize its currency at a very limited level. I don't think we should think about China as a country which is trying to compete with the US dollar. They are trying to avoid problems which are linked with the US dollar dominance, and are trying to play their own game with their own currency below that dollar dominance. And this is something which is very carefully constructed, but rather limited, and we see it in the data. And let's see how it goes on. But this is an educated guess. This is my perspective on it, right? Did I forget? Yeah?
Hi. I was wondering if you'd seen and read about the literature regarding key resources guiding hegemonic currencies, so like the oil supporting the dollar, and then following on from that, regarding sort of increasing the fiscal and policy space for peripheral countries as energy and resource independence from the oil. What's your kind of knee-jerk reaction to that? And also, following on from that, a reduction in overall trade, which is an ecologically sort of guided policy and thought process.
Okay, this is the new frontier of research, which is very interesting, and I have just created, together with Heike Jöpkes, who is chief organizing the FMM conference, we have created a PhD doctoral school funded by the Böckler-Stiftung, the Böckler Foundation, on finance and inequality in times of polycrisis, where we include also ecological aspects. So I'm expecting a generation of students engaging in this research field. But let me quickly try to line out some lines. There's this recent literature arguing that the US is an unstable hegemon because it's running a double deficit. And the question is, how long are countries willing to buy US bonds to negative interest rates? And it's a question of alternatives, but it's also a question of incentives to create alternatives. And there has been literature arguing that the US increasing its oil extraction and gas extraction has saved somehow for the last and next years its status as a hegemonic currency, because it's shrinking its trade deficit. Yes, one can argue around that. I don't think it's wrong. Regarding all the rest of the world, of course, being dependent of energy imports makes your vulnerability not only a financial vulnerability when capital flows are drying out, but it makes a real necessity to maintain imports and to get the financing for imports when you need energy. Because when you don't have energy, you saw Cuba being off the grid for days. This is the absolute disaster. So it increases vulnerability, so it adds up to it. So of course, becoming more independent by, for example, greening the national energy matrix, which includes, for example, in Latin America, and I'm just coming from Ecuador, there were huge energy cuts because the country depends very much on hydro energy, which is a sustainable energy form, but with climate change and increasing droughts, this is an energy source which gets more and more less and less reliable. So the need to change the energy matrix towards sustainable energy production, and for those countries which are not fossil exporters but importers, is there and is even stronger there for these countries because it impacts their balance of payments. Yes, there are links, but I'm really looking forward to the research agenda these PhD students are bringing in. So, I think we are done. We started a bit early, but I think you deserve. Yeah, okay. Yeah.
Many thanks for the opportunity and for your wonderful presentation. I am Raul, a student from the HTW here in Berlin, very close. I have a pair of questions regarding the real undervaluation strategies that were presented in the presentation. My first question is, which is the original motivation for this proposal or for this analysis to protect from these instabilities in the capital flows or to promote exports? Which is the primary motivation for the proposal in the case of those proposing this strategy? The second is there any case of Global South country successful with this real undervaluation strategy? Do we find empirical evidence, and if possible, which researchers have documented that evidence?
Okay, first question, from my theoretical perspective, would always argue about the reduction of external vulnerability to achieve export surpluses via an undervaluation of the exchange rate as a strategic key price. But that's a theoretical perspective. Depending on what you're looking at, you can argue the other way around. Second, China. And as I said, it's very it's a specific perspective, but you can get a reading of the Chinese ascent in economic terms via exchange rate policies and capital account policies. It is perfectly doable. The question is, this is always linked to time. So maybe it's much more difficult to explain dynamics in China over the last 5 or 10 years than explaining the ascension from the 70s, 80s on. So you always have to see if a theory applies, to see time and space there are sensible categories for the application of theory. And you always have to admit that one theory is not able to explain all and everything in our wonderfully complex world. Okay, now I think you deserve a break. Many thanks for the interesting.